Internal Revenue Service IRS tax news. IRA or IRA contributions made by July 15th count as 2019 tax deduction. So this is going to be an important thing because normally the IRA, is a type of retirement contribution. So if you work for a company, then you might have a retirement contribution. The most common one would be a 401k type of plan, which you're contributing to a 401k plan. If you don't have access to a 401k plan, or possibly if you do have access, you still may be able to put into another kind of similar type of retirement plan, which is going to be an IRA, an individual retirement account, which does a similar kind of thing, say it's for retirement. But the main reason people put money into the IRA is because a standard IRA then results in us being able to reduce the taxes at the point in time we put the money into the IRA, basically taking the deduction when we put it into the IRA. Then when we take the money out of the IRA at the end, it's subject to tax at that point in time, therefore resulting in basically a deferral of the tax for the amount that we put, at least with the amount that we put in there. Now, normally the deduction for the IRA is one of those things like when you do your tax return, the tax preparer will do the tax return. And if you have tax planning at the end of the year, they'll do the tax return and they'll say, hey, you qualify, to put money into an IRA, which is a great system because that means that because sometimes we don't really know, you don't know how much can go into a retirement account until you do like tax planning, and even until you actually get the actual numbers and process the return, do you know what the exact cap or limit is possibly in certain situations for an IRA contribution. So it's nice to be able to actually do the tax return and then say, and then see if there's an added contribution that can be made. It's nice on the tax preparer side to be able to at least, put that out there and ask about whether you want to make the added IRA. But normally the IRA would be due at the date of the tax return, when the tax return is due, normally April 15th, and it's not subject to extension, meaning if you put the tax return on extension, that doesn't mean that you can extend the date that you can put money into an IRA normally. But this time, they extended the tax deadline from April 15th or around April 15th to July 15th. So now the question is, well, does that mean that you don't have to, you can put money into an IRA up until July 15th and apply it to 2019? Because the general thought process, the general ruling is that you're able to put money into an IRA up until the due date of the return, which has now been extended to July 15th. So you would think the answer would be yes, and they're saying that is indeed the case here. So if you're doing tax preparation or if you're doing your own taxes, you get the standard question will still be there, which is, hey, it's July 15th and your 2019 tax return has been prepared. You could still put whatever amount into an IRA according to my calculations here after entering the tax return, as long as you do it before, the tax return is processed or before the deadline here, July 15th. And that rule still applies here. So back to the text. Washington. The Internal Revenue Service today reminded people that contributions to a traditional individual retirement arrangements, IRAs, made by the postponed tax return due date of July 15, 2020 are deductible on a 2019 tax return. So they're going to be part of the kind of the above the line deductions. I believe they're on the Schedule 1 deductions now, with the new kind of format of the returns that we've had since last year. Here's a quick look on the form. Here's the Schedule 1, it's attached to the 1040, and so this is going to be what we would kind of be at, like above the line or deductions for adjusted gross income, and you got your IRA deduction here that you want to check in on. Okay, back to the text. Taxpayers can file their 2019 tax return now and claim the deduction before the contribution is actually made, but the contribution must then be made by July 15th due date of the return, not including extensions. That's the general rule, right? The general rule is that you have to make the contribution by the due date of the return, which normally is April 15th, but now it's July 15th, so they moved out the due date. So you would think it would make sense that you would be able to put it in there up until July 15th. It doesn't include extensions. So if you were to put yourself on extension till October, that doesn't mean you have an extension of time in which to make the IRA contribution. So back to the text, most taxpayers who work and are under age 70 and a half at the end of 2019 are eligible to start a traditional IRA, or add money to an existing account. Taxpayers contribute to a Roth IRA at any age. So a Roth IRA is a bit different of the IRA contribution, so you can consult your tax professional to see if you want to put money into a Roth IRA. Most of the time people are looking to, the general rule is that we're trying to lower the taxes now and defer the taxes. That's the normal IRA. A Roth IRA, you'll put the money in now, but it'll be not taxed when you take it out, and depending on where your income stance is in terms of how much you're earning and whatnot, a Roth IRA could be good in certain situations. So back to the text. Starting with tax year 2020, taxpayers of any age, even those over 70 and a half, can start a traditional IRA. Contributions to a traditional IRA, there's a link to that here, are usually tax deductible, and withdrawals are generally taxable, meaning when you put the money in, you aren't taxed on it, or if it's an IRA, it's going to be a deduction on your tax return because the tax was an income and you're taking it out. If you take it out of, if it was some other retirement account like a 401k, then it's already been taken out and it's reported on your W-2. That's why you don't have to do anything else to it. It's already on the W-2. It's removed from box 1 of the W-2, and therefore that you can just put that into your system and no problem. If you had an IRA contribution, then you have to report it basically as a deduction, so it can lower pretty much like your taxable income. Now, also just remember that the IRA, the reason you put money into an IRA, if you ask most people, why do you put money into an IRA? The answer is because I'm going to save for retirement, as if the IRA account itself is the only tool you can use to save for retirement, right? And that's not the case. The reason you put money into an IRA is because you get the tax deduction for putting it into the IRA. I mean, if you didn't get the tax deduction, you would want to put it into some other account and still save for retirement. It's just that you would hold it into another account because the IRA is restricting the money. Because if you pull it out, you get penalized on it. That's the price you pay for getting the tax deduction in the current time period, which is less restriction, is a restriction to the money. So when you put it in, you get the tax deduction typically. Then you can't take it out, or else you're going to be penalized. And then you take it out basically at the end, and you have to pay the tax typically at the end. Okay, back to the text. Contributions to a Roth IRA are not tax deductible because qualified withdrawals are tax-free. In addition, low and moderate income taxpayers who make contributions to a traditional or Roth IRA may also qualify for Saver's credit. There's a link to that here. Eligible taxpayers can usually contribute up to $6,000 to an IRA for 2019. So the contribution is $6,000 for 2019. Again, if you have a 401k plan, then you want to think about how it's going to work with the 401k plan, which is another type of retirement plan, or some other type of retirement plan that you might have with your work. But then the limit is increased to $7,000 for taxpayers who were age 50 or older by the end of 2019. Contributions to a traditional IRAs are deductible up to the lesser of the contribution limit, or 100% of the taxpayer's compensation. Compensation is generally what a person earns from working. So you're going to get a deduction for it. Obviously, if you're not making a lot of money and your contribution is greater than the earnings that you have, you're not going to get the benefit from the contribution past that point. So if you're making a lot of money, like if this is your peak earning years, then the putting your money into a traditional IRA is typically good because you'll probably be in a high tax bracket, or the highest for your life, if you're in the peak earning years, right? And if you're not in the peak earning years, like if you just have a part-time job, if you're going to school or something, and you're not in the, then you might not have a whole lot of earnings, and your tax rate might not be that high. So you still might want to put money into a retirement account, but you might want to put it maybe into a Roth in that case, because your taxes aren't that high at this point in time. So back to the text. However, if a taxpayer is covered by a workplace retirement plan, the deduction for contributions to a traditional IRA for tax year 2019 is reduced if the taxpayer's modified adjusted gross income, MAGI, is. So this is if you're working somewhere else, you got another retirement plan like a 401k plan, or if you are working for the government, a 403B plan or something like that, another retirement plan does a similar kind of thing that an IRA would, then you're limited. And here we go. More than 64,000, but less than 74,000 for a single individual, head of household, or married person filing separately who didn't live with their spouse at any time in 2019. No deduction if 74,000 or more. More than 103,000, but less than 123,000 for married couples filing a joint return or qualifying widower. No deduction if 123,000 or more. More than 193,000, but less than 203,000 for a married couple filing a joint return where one spouse is covered by a retirement plan at work and the other is not. No deduction if 203,000 or more. Less than 10,000 for a married individual filing separately and lived with their spouse at any time during 2019. No deduction if 10,000 or more. So even though the contributions to the Roth IRAs are not tax deductible for tax year 2019, the maximum amount of taxpayer can contribute to reduced if their MAIG, modified adjusted gross income, is 122,000 or more for a single individual, head of household, or married person filing separately who didn't live with their spouse at any time in 2019. No contribution allowed if the modified adjusted gross income is 137,000 or more. 193,000 or more for married couple filing jointly or a qualified widower. No contributions allowed if the modified adjusted gross income is 203,000 or more. Less than 10,000 for married individuals filing separately, lived with their spouse at any time during 2019. No contribution if 10,000 or more. The Retirement Saving Contributions Credit, also known as the Savers Credit, there's a link to that here, is often available for IRA contributions if their adjusted gross income falls below certain levels. For 2019, taxpayers may be able to claim the credit if their modified adjusted gross income, basically their income, this is a credit now, the Savers Credit, so the modified adjusted gross income was not more than 64,000 for married filing jointly, 48,000 for head of household, 32,000 for single married filing separately or a qualifying widow or widower. Taxpayers should use Form 8880, Credit for Qualified Retirement Saving Contributions, link to that here, to claim the Savers Credit. The instructions have details on how to figure the credit. Worksheets related to IRAs are available in the Form 1040 instructions. So you want to, if you have questions about that, take a look at the Form 1040 instructions you can find on the IRS website. Just type in IRS Form 1040 and then and look for the instructions. There's a link to it here as well. Or Publication 590A, Contributions to Individual Retirement Agreements. There's a link to that here. The deduction for IRA contributions is claimed on the Form 1040 Schedule 1, which we looked at earlier. So you can look at that PDF here. Non-deductible contributions to a traditional IRA are reported on Form 8606. Taxpayers should also be aware that special rules allow for tax-favored withdrawals and repayments from certain retirement plans for those affected by the coronavirus, linked to that here, or those who suffer economic loss as a result of certain major disasters. Taxpayers can find answers and questions, get forms and instructions, and find easy-to-use tools online at irs.gov. More information and links are down below. You'll find a link to this in the description.